Do you want to invest to build your wealth, but are just a bit concerned about some of the companies that you would be supporting if you invested in just a broad market ETF? Well, if you were to look under the hood, there is a very good chance that there'd be a few companies in there that you wouldn't feel good about supporting. Ones to do with tobacco or alcohol or gambling or weapons. The good news is that over the years, there have been some significant advancements when it comes to ESG investing solutions, which is just to say that if you want to invest with your personal values in mind, it is so much easier to do so now compared to 10 or even 5 years ago. And that is what I'm going to be talking to you about in this video, ESG investing. Now, before diving right in, I do want to say a big thank you to BMO ETFs for sponsoring this video. In case you don't know, they have a ton of amazing and free educational content on their website. So make sure to check them out if you want to learn more about investing, but also specifically go down that rabbit hole, learn more about ESG investing, and you can find more info at etfmarketinsights.com, but also make sure to check out their channel, ETF Market Insights, because if you do, you will stumble upon a little webinar that I was the host of, and it is also about ESG investing, so make sure to check that out after watching this one. I will link to it in the description for this video. So let's start by getting a better understanding of what ESG means. So first, it's an acronym. It stands for Environmental, Social, and Governance, and these three things are important factors that an investor looks at when considering making an investment that is considered more responsible. In other words, if you want to invest in a more responsible investment portfolio, you're not just going to be looking at factors like risk, returns, and fees. You're also going to be asking some pretty specific and important questions, such as the companies in this fund, what are they doing in terms of trying to reduce carbon emissions? Are the companies in here, are they governing themselves in an ethical way? So to dig a bit deeper, under the category of environmental, you'd be looking at factors such as a company's impact on, climate change, water management, and pollution. For social, you'd be looking at factors like a company's labor standards, their human rights protections, and their health and safety guidelines. For governance, you'd be reviewing a company's business ethics, executive pay, and just overall corporate governance. Now, to give you some context, the concept of ESG investing has actually been around for a while, but it has evolved quite a bit over the years. In the early 2000s, when it all got started, ESG style investment funds started popping up in order to cater to investors' values by excluding certain companies and even industries that were in misalignment with them. For example, investment funds with religious mandates were actually some of the first types of investments like this. With that said, these exclusions were done regardless of whether it meant sacrificing returns. And that is why even still, I still hear from people that strongly believe that there is no way that you can earn as high returns with an ESG portfolio compared to a non-ESG portfolio. But a lot has changed since then, and especially after the 2008 financial crisis, a lot of things started to evolve to focus more on valuation as well as investors' values. New data, strategies, analysis, and technology made way for a broader selection of responsible investments with improved risk-adjusted returns. For example, a May 2022 article in the Journal of Impact and ESG found that after studying the returns of 80 European and 64 US funds, well, statistically, there was not a significant difference between ESG funds and non-ESG funds. Now, although in the early 2000s, when everything got started, the main method that was used was negative exclusion, in which certain companies and industries were excluded from a fund, well, over time, a lot more ESG methods have been developed, such as positive inclusion and integration. Positive inclusion means including companies that have positive ESG attributes, instead of simply excluding companies with negative ESG attributes. So this could look like an investment fund that includes companies that have the highest ESG ratings in Canada. Integration means integrating ESG risks into analysis and portfolio construction. This could look like an ETF that bases its weightings not on market capitalization, but instead on each company's ESG rating. And cut to present day, and what you'll likely see a lot of when looking at different ESG funds are products that are categorized as thematic. Now, these are investment products that focus on a specific theme, such as women in leadership or cybersecurity or climate or renewable energy. I should also mention, in case this has not been clear up until this point, you can invest in an ESG equity or stock fund or an ESG fixed income or bond fund. For example, BMO's ESG Corporate Bond Index ETF, ESGB, holds a selection of Canadian corporate bonds inside it. However, because it is an ESG fund, it does not hold any bonds from companies that earn a significant portion of their revenues from things like tobacco, adult entertainment, gambling, or firearms. Similarly, you can also invest in a fund that is comprised of both ESG stocks and ESG bonds, like an asset allocation ETF. And if you have no idea what an asset allocation ETF is, that is okay. I have made a video all about it, so make sure to check it out. I will link it in the description for this video as well. So this all sounds like good news, right? The fact that ESG investing has been growing in popularity steadily over the past few years should be a positive thing, you'd think. Except like anything that becomes popular, there's always going to be those players out there that try to get in, cash in, without actually following any of the rules. And this is what's known as greenwashing. Now, you may have heard this term before, but what it actually means is when a company makes false claims or misleads the public or represents itself as more responsible or green than it actually is. Now, why companies would want to do this is, of course, to attract investors to buy their stocks or their bonds, but also to be included in some of these new popular ESG funds. But it's not just companies that are doing this, unfortunately. It's also fund providers. There are lots of ETF and mutual fund providers that are coming out with their own line of ESG products to attract investors. But if you were to actually take a good look under the hood, you would likely find a number of companies that really shouldn't be in that fund. This is why it's so important to, before going and investing in any of these funds, do your research, take a look at what's going on under the hood. What companies are you actually supporting with your investment dollars? Because unfortunately, not all ESG products are of the same level of quality. But more than that, there may be a company in there that has a good ESG rating, but you may still not want to invest in that company for your own personal reasons. That's why before investing in any ESG fund, you need to ask a few important questions first. And one handy tool to help you, and I will include this resource in the description for this video, is this ESG ETF due diligence checklist by BMO ETFs. As you can see, it walks you through some specific questions you should be asking and considerations you should make when reviewing first an ESG investment provider and second their ESG products. For example, since there are so many types of ESG investments out there, it's important to understand what kind of market exposure you're getting and fees you're paying. You know, on this channel, I talk a lot about how I am a boring old index investor and proud of it. And so what I would be looking for is a passively managed ESG fund that gives me broad market exposure, like exposure to the overall Canadian stock market. Because of this, I would obviously want to avoid investing in a fund that is actively managed or one that is too niche and too kind of focused on, say, investing in just clean energy companies. Another thing I'd look out for, because this is a big kind of part of being a passive investor, is the fees. Now, in general, ESG funds do have slightly higher fees than non-ESG funds. However, as you can see here, there are lots of ETFs that have very low MERs. So there you have it. Hopefully you have learned quite a bit more about ESG investing than you knew before, and the different strategies that exist, and also most importantly, how to compare the different ESG providers and products out there so you can make the right decision and choice for your own investment portfolio. A big thank you once again to BMO ETFs for sponsoring this video. Make sure to check them out at bmoetfs.com for all of their amazing and free educational content about investing in general, but also ESG investing. Also, make sure to check out etfmarketinsights.com and their YouTube channel, ETF Market Insights, where they have a lot of great things, including a webinar that I hosted with two awesome and super freaking smart ESG experts. So make sure to check that out. I will link to everything in the description for this video to make it very easy for you. If you have any questions, I want to see them in the comments. Please hit that like button and subscribe to this channel if you haven't already. Thank you so much for watching, and I will see you in my next video.